Thanks, Vivek. Good evening to all of you. Thank you very much for having your trust and confidence in White Oak. And on behalf of the entire White Oak team, I assure you that we will continue to work hard to generate the best industry returns for all of our clients' portfolio. Now, today I'm going to talk on Indian chemical industry, which is at the cusp of multi-year structural growth as more and more companies across the globe are looking for an alternative and supply chain outside China. As you may be aware that China is the dominant player with 37% market share in the US 4 trillion chemical industry, while India has just 4% market share globally, which provide it a long-term growth opportunity. Even if Indian chemical companies is able to take few percentage market share from China, it can see healthy double-digit kind of growth for a long time to come. While MNC companies have started looking for alternative and stable supply sources of key starting materials few years back, as China government has decided to curb pollution, and this has further accelerated post-COVID as everyone is now looking for China plus one sourcing strategy. In our view, this provides an enviable opportunity for Indian manufacturers who have access to skilled labor along with environmentally compliant facilities. Similarly, Indian pharma and agrochemical industry, who procures over 70% of the key starting material or key intermediates out of China, are either now looking for backward integration or are encouraging domestic manufacturers to produce in India. We believe Indian government's product-linked incentive scheme to make India self-reliant in basic intermediates is a step in the right direction, and it will further strengthen India's position in specialty chemical or APIs. As you know, that India is already being considered as the pharmacy of the world, given they have a very, very strong position in the generic pharmaceutical industry. In our view, companies with strong R&D capabilities, presence in niche chemistry, and healthy balance sheet will be long-term beneficiary of this underlying trend. Now, when we look at any company in this sector, our focus is always on capabilities rather than opportunistic profit, which might have come because of demand-supply mismatch. In our view, companies that have superior management and strong R&D capabilities are best placed to show value accretive growth for a long time to come. Now, we own a couple of companies in chemical sectors, including I think what Prashant has highlighted. Some of them are being the top contributor, like Navin Fluorine and Fine Organics. In the interest of time, while I will not go into detail of each of these companies, but briefly today talk about company called Navin Fluorine, which we own in the portfolio. Navin Fluorine is one of the few companies in the entire Asia Pacific region which have a strong and dominant position in fluorine-based chemistry. And it is currently working with 8 out of top 10 global pharmaceutical companies, innovator companies, and as well as large agrochemical companies, both in specialty chemical as well as in contract research and manufacturing services. Navin, a part of Arvind Mafatlal Group, started its journey 5 decades back as a refrigerant gas manufacturer. But over time, it has moved up the value chain, and currently 55% of its revenue comes from high margin CRAMS and specialty business, which is further likely to go over 75% in next 3 to 4 years. Despite strong being up almost 150% and 300% over the past 12 or 18 months, we continue to believe that it has a long runway to grow. We believe Navin Fluorine will continue to gain market share in fast-growing fluorination market, on the back of strong execution, and while doing so, generating superior returns on incremental capital as well as maintaining very sound corporate governance. Thank you very much once again listening to me patiently.